Welcome back. Did you know that most people stay broke not because they don't make money, but because they make the wrong financial decisions without even realizing it? Maybe you feel like no matter how much you earn, you never seem to have enough. You work hard, try to save, but your bank account barely grows. Why? Because small financial mistakes, ones you might not even notice, are keeping you stuck. I've been there. Imagine this. You get your paycheck, pay your bills, buy a few things you deserve, and suddenly you're back to zero. You tell yourself you'll start saving next month, but next month never comes. The truth is, the rich don't get rich by accident. They follow certain financial rules that most people ignore. And today, I'll expose the 7 biggest money mistakes that silently destroy your wealth and how to fix them. Mistake number 1 is something almost everyone regrets later in life, yet most people still do it. Let's dive in. Mistake number 1, not investing early. Imagine you and your friend. At 20 years old, you start investing just $200 per month. Your friend, on the other hand, spends all his money and doesn't start investing until he turns 35. Fast forward to age 60. You started at 20. Now you have over $1.5 million thanks to compound interest. Your friend, who started at 35, has only around $300,000, even though he invested more money per month to catch up. This happens because time is the most powerful factor in investing. The earlier you start, the more your money grows, even if you invest less. Why is this a mistake? Many people believe they need a lot of money to invest, so they keep waiting. But waiting just a few years can cost you hundreds of thousands of dollars in lost returns. How to avoid this mistake? Start small. Even $10 a day can turn into millions over time. Take advantage of tax-advantaged accounts. If you're in the US, consider a Roth IRA or 401k. Be consistent. The key is not trying to time the market, but staying invested. Remember, the best time to invest was yesterday. The second best time is today. Mistake number 2. Living paycheck to paycheck example. Elon earns $5,000 per month, but at the end of the month, he has nothing left. Why? Because every dollar he makes, he spends. Then there's Warren, who earns the same $5,000 per month, but he follows a simple rule. 50% for needs, rent, food, bills. 30% for wants, entertainment, travel. 20% for investing and savings. After 10 years, Elon is stuck in the same place, struggling every month. Meanwhile, Warren has built a 6-figure investment portfolio and is financially secure. Why is this a mistake? Living paycheck to paycheck means you have no safety net. If an emergency happens, you'll rely on credit cards or loans, trapping you in debt. Plus, you can't invest if you're spending everything you make. How to avoid this mistake? Track your spending. Know where every dollar goes. Pay yourself first. Before spending, set aside money for investments and savings. Reduce lifestyle inflation. When your income increases, don't increase expenses at the same rate. Remember, if you don't control your money will control you. Mistake number 3. Ignoring compound interest. Imagine this. You have 2 choices. 1. Invest $10 a day starting at 20 years old. Wait until you're 40, and then invest twice as much, $20 a day. Which one do you think will make you richer by retirement? At 60 years old. If you started at 20, you'd have over $1.1 million. If you waited until 40, you'd only have around $250,000, even though you invested more each month. This is the power of compound interest. Your money makes money, and that money makes even more money. But the longer you wait, the less time you give it to grow. Why is this a mistake? Most people think they can start investing later, but later is the most expensive decision you'll ever make. Every year you delay, you lose potential hundreds of thousands, if not millions of dollars in future wealth. How to avoid this mistake? Start investing now. Even small amounts matter. Think long-term. The stock market rewards patience. Reinvest your earnings. Let your returns generate more returns. Remember, the best time to start investing was 20 years ago. The second best time is today. Mistake number 4, overspending on liabilities. Imagine this. You just got a raise. Excited, you upgrade your car, get the latest iPhone, and start dining at expensive restaurants. After all, you deserve it, right? But a few months later, you realize something shocking. You're still broke. This happens because you're spending on liabilities, things that lose value over time instead of assets that grow your wealth. Why is this a mistake? Liabilities drain your money. That fancy car? It loses 20 to 30% of its value the moment you drive it off the lot. The newest gadgets, they become outdated in a year. But investments? They appreciate over time. How to avoid this mistake? Prioritize assets over liabilities. Spend on things that grow in value, like stocks, real estate, or businesses. Delay gratification. Instead of buying a new car, invest the money. Let your investments pay for luxuries later. Follow the 50-30-20 rule. 50% for needs, 30% for wants, 20% for investing and saving. Remember, the rich buy assets. The poor buy liabilities, thinking they're assets. Mistake number 5, not having an emergency fund. Imagine this, one day your car breaks down. The repair costs $1,500, but you don't have savings. You put it on a credit card, and now you're stuck paying high interest for months. The next month, you lose your job. With no backup funds, you're forced to take on more debt just to survive. This is how financial disasters happen, not because people don't make money, but because they aren't prepared for the unexpected. Why is this a mistake? Without an emergency fund, one unexpected event can send you into a debt spiral. Most people rely on credit cards for emergencies, but high interest rates make it worse. Financial stress can ruin your focus, your opportunities, and even your health. How to avoid this mistake? Save at least 3 to 6 months worth of expenses. Start with just $1,000 and build up over time. Keep it separate. Put your emergency fund in a high-yield savings account, not in your checking account where you might spend it. Automate your savings. Set up a system where a portion of your income automatically goes into your emergency fund. Remember, the difference between struggling and thriving is preparation. The rich always protect their downside before chasing upside. Mistake number 6. Using credit cards the wrong way. Imagine this. You're at a store and you see a brand new phone. You don't have the cash, but hey, you have a credit card. So you swipe it. Months later, you're still paying for it, plus interest. What was a $1,000 phone now costs you $1,300 or more just because you didn't pay it off on time. This is how credit card debt traps millions of people. It feels like free money, but in reality, it's one of the biggest wealth killers. Why is this a mistake? High interest rates. Credit cards often charge 20% or more in interest, meaning your debt can double in just a few years. Minimum payments keep you in debt. Paying only the minimum means you'll be paying for years. Credit card debt steals your future. Instead of using your money to invest, it goes toward paying past mistakes. How to avoid this mistake? Pay your balance in full every month. Never carry over a balance unless it's absolutely necessary. Use credit cards for rewards, not debt. The rich use credit cards for cashback, travel perks, and benefits, but they always pay them off immediately. Know your interest rate. If you have existing credit card debt, focus on paying it off before investing. Remember, the wealthy use credit cards as a tool. The poor use them as a crutch. The difference? Knowledge and discipline. Mistake number 7. Impulse buying without realizing it. Picture this. You walk into a store just to look around. Suddenly, you leave with a new pair of shoes, a fancy coffee maker, and some gadgets you never planned to buy. At the moment, it feels good. But when the credit card bill arrives, you wonder where all your money went. This is how most people stay broke. They don't realize that their small, impulsive purchases are slowly draining their wealth. Why is this a mistake? Emotional spending. Retailers use psychology to make you buy things you don't need. Sales, limited time offers, and flashy ads trick your brain into spending more. Death by 1,000 cuts. A $5 coffee here, a $20 dinner there. It doesn't seem like much, but over time, it adds up to thousands of dollars wasted. The cycle of regret. You buy something, feel happy for a moment, then regret it later when you realize that money could have been invested. How to avoid this mistake? Follow the 24-hour rule. Before buying anything unnecessary, wait a day. If you still want it, it might be worth it. Set a spending limit. Decide beforehand how much you can spend on wants each month, then stick to it. Invest first, spend later. The rich put their money into assets before buying luxuries. The poor do the opposite. Remember, the key to wealth is not just making more money, it's controlling how you spend it. The difference between the rich and the broke. Now you know the 7 biggest money mistakes that keep most people broke. The question is, will you keep making them or will you change? The difference between the rich and the broke isn't luck. It's the decisions they make every day. The rich invest early and let their money grow. The rich avoid lifestyle traps that drain their wealth. The rich educate themselves about money instead of ignoring it. If you fix these 7 mistakes, you're already ahead of 90% of people. But knowing isn't enough. You have to take action. Which mistake are you going to fix first? Drop a comment below. Click on the video on your screen to learn the investing strategy Warren Buffett used to become a billionaire.